Welcome to Module 7. This module has a little bit of everything going on. We definitely start to dig in on more complex costing information and decision making, so we should be stretching a little further than the previous two modules. This video is on relevant costs, which is an important concept, but also fairly intuitive. Fair warning on the upcoming videos of Module 7. You will see more and more I will leave the PowerPoints behind and spend more time in Excel demonstrating how to solve the more complex problems. This always frightens me a little bit because every time I go to a course or a seminar and the instructor starts typing into Excel, well, as a result, I strongly recommend working in Excel as you watch. Now, I understand that might mean either two screens, maybe one could be your phone, or a lot of pause work. Two screens is the better option, but neither is great. Do your best to stay frosty, and here we go with relevant costs. All right, here's the Module 7 learning objectives. Not too many. We're going to identify relevant costs for decision making and apply in a number of different situations, such as special order, make or buy, lease or buy, additional processing, and keep or drop. We're going to analyze capital investments using discounted cash flow. So we're going to put on our finance hats for a video and see if we can resolve some of these net present value issues. And then lastly, we'll talk about target costing and theory of constraints as it relates to strategic management. Okay, but let's start with relevant costs. So a relevant cost is a future cost that differs between and among decision alternatives. And I'm hoping that you covered relevant costs somewhere down in your lower division course. So both characteristics must be present for a cost to be relevant. It must be a future cost and it must differ. So relevant costs can be variable or fixed, but generally speaking, variable costs are relevant and fixed costs are not. Now, that's not a whole rule. I mean, there are exceptions always. And relevant cost analysis and a total cost analysis should produce the exact same result. Really what you're doing is trying to save time. So a sunk cost is a cost that's been incurred in the past or committed for the future and is therefore irrelevant. It's a sunk cost. There's nothing we can do about it. Okay, so with that in mind, Jim is planning a trip to Denver. And this example is a little old, I won't lie to you. He doesn't need to go to Denver anymore. He can stay right here in California if he so chooses. But he's going to Denver to enjoy 420 on 420. So he has two alternatives for getting there. Jim could fly. So if Jim flies, he's got to buy, of course, an airline ticket. He'll have to take a taxi from the airport in Denver. He'll need to park here in San Diego. Of course, on his trip, he'll need a hotel in Denver. He'll need meals while he's in Denver, or at least, a couple bags of snacks. And then he's going there for 420, so he's got to buy his weed. The flip side is Jim could drive. So if, of course, Jim drives to Denver, then he's got the gas, oil, and depreciation on his car, and our estimated cost for that is $170. And then he's got, of course, the same hotel in Denver. He's got to have meals while he travels. He also has meals while in Denver, and of course the cost of his weed. And so Jim is trying to figure out, well, what's his best alternative? And we're looking at this in purely a financial perspective, because obviously it takes much less time to fly there than it does to drive to Denver. Okay, so we could look at all costs and compare. And in our previous example, I actually gave you all costs, but that's hypothetical. But what we really want to do is only look at the relevant costs, because to the extent that we have to go figure out what an irrelevant cost is, it's not critical to understanding which alternative is better. Now, that's not to say that that might not be critical information from some other perspective, but at least from the perspective of comparing these two alternatives, it wouldn't be. So here's the information broken down. In what we have is in the first two left columns, plane and drive. That's called a total cost comparison, right? So I've dropped in the total cost of each. And you can see that if you, of course, fly, you have a plane ticket, you've got the taxi, the parking, but you don't have any of the driving costs. And then, of course, if Jim drives, then he's got the hotel meals and the weed, but he's also got the gas and oil and the meals while on the road. And so the total cost to fly is $608. The total cost to drive is $495. And you can see in that middle column, the difference is $113. So the far right is a relevant cost comparison. And you can see that all we've done is isolate the costs that are relevant to these two alternatives. So those are the ones that are future costs that differ. And you can see the plane is only the different costs and the driving is only the different costs. Now, since I had already provided for you the hotel, the meals, and the weed, well, it is no work on your part to include those for the most part in your analysis. It means a few more lines on the table, but kind of who cares. But the reality is, from a comparison perspective, you don't really need to know what that hotel costs. And so maybe we save the time of calling the hotel, getting a price, trying to figure out which one of these things we want to do from a relative perspective, right? Because that's a non-relevant cost. Now, clearly the cost of the hotel is relevant from the perspective of a budget perspective. And we'll talk about relevant costing from a budget perspective in a few videos. But right now we're focused on relevant costs when we're doing a alternative comparison. Okay. So costs that are incurred in the future that will differ between decision maker options. So here's a couple that wouldn't differ, right? So clearly Jim has to pay taxes on his car in California. But is that relevant? Well, no, it's not, right? Jim's going to have to pay the taxes on his car in California, whether he drives that car to Colorado or not. Jim's going to have to pay interest on his car loan. He's going to have to do that whether he drives it to Colorado. He's going to have to do that whether he drives to Colorado or not. And so in this way, those are largely, think of those as fixed costs, right? And they tend to be irrelevant. Okay, so this is a book example on classification of costs for relevance if you were buying a car. And I'm not going to go through this in detail because it's right out of the book, but I think you would see that it largely maps to the example we just presented. Okay, so let's do a quick practice exercise. So we've got a decision to keep an old machine, or we're going to replace it with a new, more efficient machine. And the question is, which of these costs are relevant? So the original cost of the old machine, that feels to me like a sunk cost, and it's probably not relevant. The book value of the old machine, that might be relevant though, because it's going to dictate the gain or loss that we're going to recognize perhaps when we dispose of the old machine. The purchase price of a new machine is clearly relevant. Whether it has a zero salvage value will ultimately bake in to ultimately see, you got to stay frosty, and it's not even working for me. The new machine, zero salvage value, that's going to be relevant when it comes time to decide what the terminal value of that machine is. Repairs to the old machine of $3,500, that would allow one more year of productivity. That's relevant. That's going to matter if we choose that alternative. Power for either machine is expected to be $250 an hour. That sounds non-relevant. It doesn't differ between the two. Whereas the new machine will reduce labor costs by 50 cents an hour. Well, that's flat out telling us it's going to be different. The expected level of output for next year is 2,000 units. That's relevant only because it's going to weigh into our labor cost calculation. But in some respects, otherwise, if output was the same, it wouldn't matter. Clearly, if output differed, it would matter for sure. So when we think about this laundry list of items, which ones aren't relevant, it's those two, and everything else is going to have some impact on our decisions. Okay, so here is a total cost analysis of our two perspectives, repair versus replace. And you can see we've got the labor costs between repair and replace. And remember, we were going to save 50 cents an hour. Power was the same, so that would be irrelevant. Depreciation on the old machine is the same, that would be irrelevant. The repair cost clearly is different. The cost of the new machine, obviously, those differ between the two alternatives. So replace minus repair, we have a $2,500 difference. It looks like repairing is the better way to go here. So now we look at only the relevant costs, and you can see what we've really done is pulled out the parts that were the same under both scenarios. We're left with only the things that are different, but we get the exact same result. Okay, so when we think about relevant costs from our kind of cost accounting perspective, make sure we consider batch level cost drivers. Because if a setup on one machine takes longer or requires more skilled labor than the other, you got to consider those factors. And then you also need to consider opportunity costs. And so if you go back to our 420 example with Jim headed to Colorado, we definitely ignored the opportunity cost that might exist. So for example, what if, because Jim's flying and it takes so much less time, what if he doesn't have to take any time off from work? Right, so that's an opportunity cost that we would need to consider, or maybe Jim would do something different with his money. In any event, those are things that you generally want to consider when you're doing these analyses. So depreciation generally isn't included unless you're considering tax implications, because depreciation often changes, particularly in a replace versus upgrade kind of situation. If I invest in new capital, it probably changes the depreciation rates. So really what you'd say is depreciation on your old machine probably isn't relevant. Time value of money would be relevant if the cash flows take place over 2 more years. And in a couple videos, we're going to dig in on that big time. And then there are a number of course, qualitative factors that you would need to consider, right? So if I'm replacing an old machine with a new machine, are there differences in quality? If I'm going to make a part versus buy a part, are there differences in quality? Will it function identically, depending on the two situations? Will I be able to expect delivery if I go to buy a part instead of make a part? Is my supplier reliable, right? Is shipping reliable? And then lastly, after sale service level, right? So if there are quality issues, am I going to end up needing providing additional assistance to customers, this sort of thing. That is the end of video M11A on relevant costing. Now that we understand how to isolate relevant costs, we can start to apply them in strategic decisions in video M11B. Thanks for watching.
We're all in strung out shape. But stay frosty and alert. We can't afford to let one of those bastards in here.
All right. Oh.